I'll be covering the 5 key types of financial ratios for Google, covering the past 3 years. These financial ratios are a way to evaluate the company's performance and compare it to similar businesses in their industry. I will start with activity ratios. Activity ratios indicate how efficiently a company is managing its assets. A high inventory turnover ratio is preferable, but it indicates that more sales are generated from a certain amount of inventory. A high receivables turnover ratio can indicate that a company's collection of accounts receivable is efficient, and the company has a high portion of quality customers that pay their debts quickly. A high receivables turnover also might indicate that the company operates on a cash basis. For liquidity ratios, because the current ratio is increasing while the trend of the quick ratio is decreasing over the period, this could be a warning that Google could be carrying excess inventory. However, both are even with this one, which would mean that Google is currently carrying excess inventory. A decreasing price to the earning ratio might indicate that the current stock price is low relative to earnings. Because the price to book ratio is above 1, this indicates that the stock price is trading at a reasonable price relative to the value of the company's assets. And now for profitability ratios, the operating margins measure how much profit a company makes on a dollar of sales after paying for variable costs of production, such as wages, raw materials. And then we have the higher the gross margin, the more capital a company retains on each dollar of sales, which can then be used to pay other costs or satisfy debt obligations. Okay, an increasing return on equity, ROE, can mean that the company is good at generating shareholder value because it knows how to reinvest its earnings wisely. This also would increase productivity and profits. And return on assets, ROA, this rises over time, indicating the company is doing a good job of increasing its profits with each investment dollar it spends. Generally, the higher the ORI percentage, the greater the return on the investment, which indicates an increased efficiency and profitability. Increases and decreases in sales will have a direct effect on net profits. The low net profit margin means that the company uses an inefficient cost strategy or poor pricing strategy. The higher the asset turnover ratio, the more efficient the company is at generating revenue from its assets. For financial leverage ratios, they measure the overall debt load of a company and compare it to the assets or equity. The debt to equity ratio of 1 would mean that the investors and creditors have an equal stake in the business assets. A lower debt to equity ratio usually implies a more financial stable business, which we have here. Similarly, a decrease in long-term debt to capital ratio would mean that there is an increase in stockholders' equity. And now for the industry analysis, comparing Google to industry. This graph compares 5 years of cumulative total return to shareholders on common stock. And as you can see, Google is mostly outperforming the industry on shareholder returns.